Hey, good afternoon, everybody. Jeremiah Conjure here from Annuity Association, and we're bringing back another exciting unbiased annuity review. Today, we're going to be discussing the Index Protector fixed indexed annuity offered by Great American Insurance Company. This has been a popular selling annuity in the registered investment advisor space, and so I wanted to take a moment, since it will be the first review we've conducted of a product offered by Great American. So I wanted to take this opportunity to put some information out there regarding this particular product, since it seems to be gaining some momentum in the registered investment advisor space. So for those not familiar, if this is the first time you're tuning in to one of our unbiased annuity reviews, the premise of each one of these reviews is to break down the pros and cons of every single annuity. And we do that by taking a look at the consumer brochure, breaking down all the features and benefits located there. And then we also take it a step further and come back to our software, where we will break down the current indexing strategies that are offered in these types of annuities to see how they would have performed over the last 10, 15, and 20-year periods. So it gives us an idea of what we can potentially anticipate, and as far as returns go, if markets should perform like they have over those three different time frames. I also start these reviews out with some gratitude. I can't say thank you enough to the people that have been tuning in and watching these product reviews here on YouTube and Facebook. The feedback has been super positive and incredibly humbling and motivating, to say the least. And our premise is simple here at Annuity Association, and that is to create a better annuity buying experience using education and full transparency to help our prospective clients ultimately make an educated decision on whether an annuity is right for them, and if so, which one is going to help them meet their needs, objectives, and goals moving forward. So if you'd like to work with me directly before we get started here, you can visit our website at annuityassociation.com, right there on the main button, to request your free report, and I will contact you in a timely fashion to see how I can help point you in the right direction. Okay, without further ado, let's go ahead and start with our handy dandy annuity review disclaimer. So let me get that pulled up here and we will get started. So again, we're talking about the Index Protector 5-year and 7-year version offered by Great American Insurance Group. This is a fixed indexed annuity and an unbiased independent review by annuityassociation.com. This is a review, not a recommendation to buy or sell an annuity. Great American has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors, so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of annuityassociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so we've gotten that out of the way. Let's go ahead and dive into the product brochure. Again, we're referring to the Index Protector 7 in this version of the brochure. This is, again, a fixed indexed annuity offered by Great American Life Insurance Company. So before we get started in the brochure, kind of, to help identify or whether or not an annuity may be right for you, or a fixed indexed annuity for that matter, if you're looking for safe growth, if you're looking for pure accumulation, and you're not keen on taking market risks or, just dealing with the levels of volatility that we're currently experiencing in the stock market, an indexed annuity can be a potential suitable alternative to allow one to, still participate in the upside growth of the market without experiencing any of the downside risk that's often associated with being in the stock market. So if you're finding yourself approaching retirement within the next handful of years, and you're looking to put a guarantee of protection on a portion of your nest egg, an indexed annuity can be a great solution to do just that. In addition, if you're looking for more stability, more peace of mind, and ultimately just more clarity in regards to your overall retirement nest egg, and that at least a portion of it's going to be free and clear from market risks, an indexed annuity may be something for you to consider. So we'll be uncovering this one today to really just break down the pros and cons, features and benefits to see if this is one that may pique your interest. All right, as with most annuity brochures, they show a lot of inspirational pictures, showing some people maybe approaching retirement or have recently retired, gardening in their what I assume to be their home garden. We see some nice, lovely flowers, some stones on the coastal edge there in the surf. Someone scuba diving, so all fun stuff. It's what we really envision, right? When we talk about retirement and think about what retirement means to us. Everybody's a little different, but what the most common thing that we all aspire to achieve, and that's ultimately happiness and peace of mind. And it's really going to come down to what vehicles in the financial realm are going to help you achieve a level of those things. And an indexed annuity is, in my opinion, obviously one of those that can potentially do just that. So first, let's talk about diversifying your portfolio with the Index Protector 7. A fixed indexed annuity can offer growth opportunity. Within the annuity itself, you can allocate your money to different interest strategies that may help you accumulate more assets for retirement. You also will receive the benefit of protection from stock market loss, regardless of market conditions. You won't lose the money you contribute to your annuity unless you take a withdrawal or surrender your contract during its early withdrawal charge period. Most annuities, let me rephrase that, all annuities have the ability to convert the contract or accumulation value to a guaranteed retirement income stream. When you're ready to turn the money you've accumulated in your annuity into retirement income, you can select from a variety of different payout options, including an income stream that will last for the rest of your life. Now, that is just one of the options. It's not mandatory or required. You can absolutely use an indexed annuity just for a safe accumulation vehicle without the intention of converting it to a lifetime income stream. You can also treat it as just a vehicle that safe harbors a portion of your nest egg, and then use what we call systematic withdrawals off of the contract value as those monies grow over time. Again, not converting to a lifetime income stream or annuitizing the contract in any way, just using it as a systematic withdrawal approach to supplement the other streams of retirement income you may have. So why should one consider an annuity? Investing in the stock market can be a lucrative way to grow your savings. However, with no protection against loss, market downturns could cause your nest egg to take a significant hit. To avoid losses, you may turn to fixed income investments. By mitigating your risk, it could mean getting little in return. If you're looking to supplement your portfolio with greater growth opportunity and no market risk, the Index Protector 7 fixed indexed annuity might be the answer. So what is an annuity? Simply put, an annuity is a contract between you and an insurance company. It is a long-term financial vehicle that's designed to protect and grow your money and then provide a stream of income during your retirement. In fact, other than pensions, annuities are the only products that provide guaranteed lifetime income. And again, diversifying your portfolio. So let's talk about the traditional approach, maybe that people like my grandparents used. And that is a traditional investment portfolio, typically consisting of a 40% fixed income investment mix, such as bonds and CDs, along with 60% in equities and or stocks. This approach may no longer be enough to help you reach your goals. By allocating a portion of your portfolio to the Index Protector 7, you could benefit from greater earning potential, principal protection, guaranteed lifetime income. So here they break down a diagram, and it's a hypothetical example of showing a portfolio with a traditional approach. You'll see the purple color is your stock mix. You'll see the, I guess that's a green or lime green colored would be your fixed income instruments such as bonds. And then you'll see the gray, dark gray is your cash. And if you move to the right-hand side of the screen, you'll see that now by reducing a portion of the fixed income instruments like bonds and putting some of those dollars in a fixed indexed annuity, we're actually creating an optimization by doing that, especially in today's current low interest rate environment where bonds are not kicking off the yield they once did, 10, 15, 20 years ago. You're left with a couple options that are considered alternatives. You either take more investment risk and put more money of your a larger portion of your portfolio in equities, or you look at things like a fixed indexed annuity, which is a suitable alternative to bonds, still giving you that downside protection risk with a 0% floor, so you can't lose any money due to market risk. But in addition to that, especially in today's environment too, where we may or may not be experiencing some high levels of potential inflation, an indexed annuity is a vehicle that can keep up with inflation because of the index strategies that are offered inside them. So you get the peace of mind of principal protection and no downside risk to market losses, and it keeps up with inflation. So I think it's a very suitable alternative, and something, if you're not familiar with this approach, it's definitely something to take a look at further. So let's look at picking your path to growth. Fixed indexed annuities offer multiple interest strategies to help you build your savings. Index strategies offer you the unique opportunity to earn interest based in part on market performance without the risk of market loss. A declared rate strategy allows you to grow your money at a fixed interest rate that is set at the beginning of each one-year term, and you have the flexibility to choose the strategies that are right for you. We know your needs may change over time, so you can revisit your strategy selections at the end of each term. So in an indexed annuity, you're going to have two ways to grow your money. You're going to have obviously the index strategies that are offered, which are tied to various market-linked indexes, and you'll be credited the interest based on how those underlying indexes and the strategies you choose perform over that crediting period. Or these annuities will also offer a fixed rate strategy, which is basically a fixed account that'll have a declared guaranteed interest rate for 1 year, and that will annually renew. That rate can be higher or lower every single year, depending on what the company renews that interest rate at. So 99.9% of the clients that I work with, they choose the index strategies, but there are some indexed annuities that have very competitive fixed offerings, some as high as 3 to 3.5% right now, which may be attractive depending on what's important to you. So for the declared fixed interest rate, the interest is credited daily there. It's a fixed interest rate set at the beginning of each one-year term and guaranteed for that particular year. And then on the index strategies themselves, in the Index Protector 7, there is a 1-year point-to-point and a 7-year cap lock annual point-to-point. On the 1-year point-to-point, that is an annual interest credit. So every year at the end of that year, you will receive an index credit as long as there was positive performance, and that will be given on the last day of each term year. And then the rate is guaranteed, which is the cap or participation rate, and that's set at the beginning of each one-year term and guaranteed for that term. On the 7-year cap lock annual point-to-point, same thing. The interest credit will be given on the last day of each term, and the cap is set at the beginning of the 7-year term and guaranteed for the entire 7-year term. So this particular product is going to offer a 7-year point-to-point and an annual point-to-point. I'm an advocate for the lesser terms. It's just a personal preference. In addition to that, our research indicates that there are products out there that will offer a lower crediting period or a lesser crediting period, but still offer a higher yield or higher potential for growth there. I just don't personally like the idea of putting money into an account and waiting 7 years to know what interest credit you're going to get. It's just a very long period of time, and it's not something that I personally would prefer. But again, everybody's different. I'm not saying that it's good, bad, or indifferent. It's really going to come down to what makes sense for your particular situation. So how do the index strategies work? It's simple. Funds in an index strategy earn interest based in part on the positive performance of an external index, such as the S&P 500. Interest is credited on the last day of each term year and is guaranteed to never be less than 0%. The Index Protector 7 offers point-to-point index strategies. These strategies compare the closing value of the index at the end of a term year to the closing value on the first day of the term year. If the result is positive, interest is credited. If the result is negative, the credited interest rate is 0%. Remember, we have that guaranteed principal protection where our interest credit will never be less than zero. You'll never have a negative credit applied to your account. So in essence, you'll never lose money due to market downturns or negative years in the market. The amount of interest credited at the end of the term year is limited by either a cap or a participation rate. So what's a cap? A cap is the maximum interest rate that will be credited for a term year. So for example, let's say you have a 5% cap on your index strategy. If the index strategy went up 7% in any given crediting period, well, obviously because you have a ceiling or a cap of 5%, the max you would be credited is 5%. A participation rate is the percentage of a positive index change that will be credited for a term year. So a participation rate is basically if, let's say, your index strategy that you're allocated to had a 10% growth for that particular year, and you had a 50% participation, the participation rate declares how much of that positive growth do you get credited or do you participate in as the annuity owner. So if it went up 10% and you had a 50% participation, you would get an interest credit of 50% of that 10% gain. So that would be 5% net as a credit to your contract value. Any interest credited to your account value is locked in at the end of each term year and cannot be lost due to future market performance. So this is a very important point to note, is that anytime you are credited interest, okay, that interest is locked. It can never go down. It's never exposed to market losses. So the very next year, let's say after the first year getting a 10% credit, the very next year, the market went down 20%. We're entering a recession, whatever the case may be. Your 10% gain from the year before is locked in. It can never go down from where it is. So it's very important to note. And in addition, there's another feature. I'm glad they brought it up in this brochure because it's one that I feel that is often overlooked in all annuities that offer these types of crediting strategies, is what's called an annual reset. So here they say protect your earnings with annual reset. A fixed indexed annuity not only protects your principal, it also protects your earnings with an annual reset. Any interest credited to your account value is locked in at the end of each term and cannot be lost due to future market performance. Additionally, if index performance is negative for a term year, your annuity can earn interest the next term year, even if the index has not made up. Let me read that again. Even if the index has not made up its previous loss. This means your annuity earns interest for any term year in which the index change is positive. So this is, in my opinion, the number one overlooked feature and benefit of an indexed annuity, and that's the annual reset. So if you look at the stock market, let's say you're invested in the stock market and your portfolio goes down 10% for any given year. Well, you now have to, the very next year, to actually earn above and beyond what you lost, you have to break even first, right? You have to at least accrue back or earn back that 10% loss. And then however long that particularly takes, then anything above that point would be positive growth, right? Well, in an indexed annuity, that doesn't have to occur. Let's say 1 year it goes down 10%. Well, you're going to get credited as zero. But the very next year, the next crediting period, you don't have to wait for that index to get back to where it was once before and break even. You have a new reset period. So on your anniversary date, you're going to receive communication that tells you what the starting value is of the underlying index you're allocated to. And that's the new starting point. So you'll hear point-to-point index strategies using a point-to-point with a participation rate. So your starting point is on the date of your anniversary, and that's your new point. So it doesn't matter if it came back up and broke even. It doesn't matter. You're starting wherever it is at that anniversary. And then fast forward to that next anniversary point, that would be your ending point of that point-to-point crediting period. If the ending point is higher than the beginning point, well, then you had positive growth. So the annual reset is a key feature only found in indexed annuities, and it's essential to, earning interest even in very volatile or down markets, because you always have a new reset point upon your anniversary date. So you don't have to wait for your index to get back to even. You just start back where it is at that present time. And that's a huge benefit. So here they show how the annual reset works. You'll see this graph. The light blue is showing the index performance, and then you'll notice the dark blue line and the star on from the left of the axis there. You'll notice that there's various locking periods where it locked in the interest credit, but then it's showing that maybe during that period of time after the lock occurred, the index performance actually went down. Well, because you started at that locked in period, okay, you just go up. In an indexed annuity, you can only go up. You'll never go down. So they'll show you here the green lock is the index performance is positive. Your annuity earns interest that is locked in and protected from future index declines. And then the second lock, where it was actually flat, you'll notice there's no positive gain there. In term year 2, the index performance was negative. Your principal and earnings remain protected, leaving your account value unchanged. And then the blue lock is the index begins to recover. Your annuity earns interest even though the index has not made up its previous loss. So your starting point is just from where you start with that new index value. So if you do end up starting at that lower point, which is great, then you get to ride up that momentum and those positive gains as well, and then lock them in again. Huge perk there. Again, the number one feature often overlooked in indexed annuities. Not enough advisors or agents talk about that feature. Additional benefits, tax treatment that allows faster growth. You don't pay taxes on the interest your contract earns until you start receiving payments or you take a withdrawal. So your money can grow at a faster rate than it would in a taxable product. Guaranteed retirement income with life expectancies on the rise. You may worry about outliving your savings. Unlike equities or fixed income investments, the Index Protector 7 provides the opportunity to turn the money you've accumulated in your annuity into a steady stream of retirement income. Depending on which payout option you choose, income benefit payments are made for a specific number of years or for life. So in these types of annuities, you can request a lifetime income payment, or you can modify it and customize it to your liking, maybe just asking for income for 5, 10, 15, or 20 years without the guarantee for life. So it really depends on what you're looking to accomplish, but there are some flexibility options there at your disposal. And protection for your loved ones. No one likes to think about it, but part of achieving peace of mind is knowing what would happen to your money if you pass away unexpectedly. With the Index Protector 7, any death benefit is paid directly to your beneficiaries, which allows them to receive your financial legacy without the cost and delays of probate. So again, probably one of the top misconceptions of annuities is that if you pass away, the insurance company keeps your money. Entirely false. If somebody's telling you that and they're a financial professional, you need to run. You need to talk to someone else, because they do not understand annuities, or they do, and they're just lying to you and trying to talk bad about them for whatever reason. In an indexed annuity, you're going to have a death benefit column that will always match the contract value. And should you pass away, even during the surrender period, which in this case is 7 years or 5 years if you're looking at the shorter term, if you happen to pass away during that time frame within the surrender period, 100% of the contract value would be paid to your designated beneficiaries. And in addition, you would avoid probate, or they would avoid probate. So it's a huge perk there. Again, one of the biggest misconceptions of annuities is that if you die, the insurance company keeps your money. That's 100% false. Okay, so let's talk about considering your liquidity needs. The Index Protector 7 is intended to be a long-term product. However, you will have access to a portion of your money each year with penalty-free withdrawals. During the first contract year, you may withdraw up to 10% of your purchase payments. After the first contract year, 10% of the account value on the most recent contract anniversary may be withdrawn. It's important to note withdrawals in excess of this amount may be subject to early withdrawal charges and a market value adjustment. Early withdrawal charges and market value adjustments end after 7 years. And for additional peace of mind, the Index Protector 7 offers a return of premium guarantee after contract year 3. So this is a feature that's starting to become more popular across the indexed annuity space, and that's what we call a return of premium guarantee. And it's the insurance company's ways of kind of putting their money where their mouth is. If for whatever reason you're not satisfied with the growth, or maybe you just have a change of heart and your needs change as well, you can request a return of your initial investment, which is referred to as the premium, anytime after contract year 3. So that's a huge perk. I mean, they're saying that they'll give you your money back if for whatever reason you're not happy. So it's just another added feature, an added peace of mind feature, if you will. And I think that that's something that's starting to become a little bit more popular as these new products come on the market. Now, indexed annuities are not new. They've been around since 1995, but just within the last 5, 7, maybe 10 years at most, these products have gotten really innovative to, help retirees and pre-retirees put a portion of their money in a safe accumulation vehicle. And now they're adding these additional provisions and perks to just give additional levels of peace of mind. And Great American's simple promise to you is superior service and annuities that are easier to understand. Oftentimes, annuities can be somewhat complex. I do my part in trying to break down those complexities to help you understand them to the best of my ability. And Great American's on that front as well in trying to simplify these great, unique products. They are an A+ rated carrier according to AM Best. So when it comes to financial stability, they are at the top of insurance companies. So at Great American, it pays to keep things simple, serving with great pride for more than a century. With a heritage dating back to 1872, Great American's insurance companies have a long history of helping people achieve their financial goals. Great American Life is a member of Great American Insurance Group and a subsidiary of American Financial Group, which is publicly traded on the New York Stock Exchange. Headquartered in Cincinnati, Ohio, American Financial Group has assets of $70 billion. The importance of financial strength with medical advances in healthcare leading to increased longevity, it's important your retirement may last longer. It's possible that your retirement may last longer than 30 years. That's why it's important to work with a company that has a long-term financial strength and experience. Great American Life Insurance Company is proud to be rated an A+, which is a superior rating from AM Best, and A+ as well from Standard & Poor's. Okay, so let's talk about some of the quick features here. The issue ages are 0 to 85 years of age for qualified and non-qualified, and for inherited IRAs or inherited non-qualified dollars, it's 0 to 75. Purchase payments, you can purchase this annuity with an initial purchase payment of $100,000 or more. You can add to your annuity during the first 2 contract months with additional purchase payments of at least $25,000. Fees, there are no upfront charges. All your money goes to work for you immediately day 1. Keep in mind, you will pay a fee to your investment advisor for the services he or she provides, but you will not pay any administrative fees to Great American. Interest crediting strategies, declared rate. There's also the S&P 500 1-year point-to-point with a cap, the S&P 500 7-year cap lock annual point-to-point, the S&P 500 risk control 1-year point-to-point with participation rate, the S&P U.S. retiree spending 1-year point-to-point with participation rate, the iShares U.S. real estate 1-year point-to-point with cap, and the iShares MSCI EAFE 1-year point-to-point with cap. These available strategies may vary state by state, so depending on where you live, some of these may not be available. Again, there is that 7-year cap lock strategy, which is a 7-year term. All the other strategies have a 1-year term, and the fixed rate is also guaranteed for 1 year. You can change your strategies at the end of each 1 or 7-year term. Funds held in the 7-year strategy will automatically reallocate to the S&P 500 1-year strategy unless you elect otherwise. The penalty-free withdrawals, which we just discussed, is during the first contract year, you may withdraw up to 10% of your purchase payments. After the first contract year, 10% of the account value on the most recent contract anniversary may be withdrawn. Amounts withdrawn in excess of the penalty-free withdrawal allowance may be subject to early withdrawal charges and a market value adjustment. And for early withdrawals during the first 7 contract years, an early withdrawal charge starting at 7% is applied to surrenders and withdrawals that exceed the 10% penalty-free amount. All charges end after 7 years. So what they're saying is this is a 7-year commitment in this product. If for any reason you need to access above and beyond that 10% free withdrawal provision, any monies above that 10% threshold will be exposed or have the potential of having an early withdrawal charge incurred. Given the different contract years, those early withdrawal charge percentages change. The first 3 years is 7%, and then it goes down by 1% years 4 through 7. Okay, so we've talked about all of this stuff, so I'm not going to spend any more time there. I really want to get quick into the analyzer portion of our review here, and that is going to be for looking at the specific index strategies themselves to see how they fared over the last 10, 15, and 20-year period. So bear with me. I'm going to go ahead and share my screen again. Let me go ahead and get that pulled up. Thanks for your patience. And while we're waiting and pulling this up, if you like what you've heard thus far, maybe you're getting some value out of this review, if you'd give us a thumbs up here on Facebook or YouTube and share this video with any friends and family that you feel potentially would appreciate this type of information, it would be I would be very thankful for that. That's the way that these videos get ranked, is based on your feedback. So if you think that this is a good review and you're getting some value, please give us a thumbs up. It would be appreciated. In addition, if you'd like to work with me directly and maybe comparing this particular product to either one that you currently own, or maybe you're just starting out on your research and you'd like to really take a deeper dive into the various indexed annuities on the market, and you're looking to find the right one that's going to meet your needs, goals, and objectives for now and in the future, I'd be happy to take you through that comparison process. It's not anything that I charge for. If you'd like to work with me directly, you can go to annuityassociation.com. Right there on the main page, click the green button to request your free report. And on that, you'll be taken to an opt-in form, which will ask you a series of questions. One of those questions will be, would you like to be contacted by an advisor? Simply answer yes, and of course, leave your phone number, and I'll reach out to you in a timely fashion to see how I can help point you in the right direction. Okay, so we've got our performance analyzer up. So let me go ahead and share the screen. Okay, so here what we're looking at is we take all of the indexed annuities available on the independent annuity marketplace, and we take them through what I call a backtesting exercise. And it's taking a look at every single annuity and every single index strategy itself, and taking it through a back test to see how this particular index strategy would have performed if we owned it during the last 10 years. So in this particular case, we're going to see the Index Protector 7, and we're going to see the various index strategies that are offered in this particular product, and really take a deeper dive in seeing what this would have potentially have done if we own this product during the last 7 years. Now, this is just a hypothetical back test. It is not an indicator of future performance, but it still gives us a layer or level of understanding when it comes to seeing, well, we know what the last 10 years was like. How would this product have performed then if everything was the same in terms of the offerings and the parameters of this indexed annuity today? So we're not going to have, unfortunately, the 7-year crediting strategy for this particular product. We haven't gotten that loaded in here, but I would be hard pressed to think that anybody really is putting their monies in that strategy given the longer tenure. Some people do, I'm sure, but My feedback that I've received from clients is that they would prefer a shorter window when it comes to putting their monies in, so that they can really get an idea of what those index credits are sooner than later. So here we're looking at all the various one-year point-to-point strategies. You'll see at the top we have the one-year S&P 500 average daily risk control index with the 10% volatility trigger. This is a participation rate index crediting strategy using a point-to-point. So 1 year point-to-point, we'll see the participation rate at the time of this review is 70%. And based on that data, over the last 10 years, from December 31st of 2010 to December 31st of 2020, this particular product hypothetically would have performed on average of a 5.28% average annualized rate of return. In addition, we take a look at the best and worst 10-year periods of that time frame. We'll see from December 30th of 2009 to December 30th of 2019, we had a return of 5.65 as the highest 10-year period. And then in addition, we take it a step further and look at what the lowest 10-year period would have been, and it's 5.28%. And then you'll see just below that, this particular product, sometimes the participation rates do vary. This is just assuming that the participation rate was only 65%. And if that was the case, you'll see the return come down just slightly to 4.91 over the last 10 years, with the highest 10-year average of 5.25 and the lowest 10-year average of 4.91. And then moving on down below that, we'll see the S&P U.S. Retiree Spending Total Return Index with the 1 year point-to-point participation rate at 80%. And we'll see the average 10-year performance, which is an average annualized rate of return of 4.63%, and the highest 10-year performance at 6.04, and the lowest 10-year performance at 4.63. Now those red numbers are still a positive number. It's just red because it's indicating the lowest 10-year period out of that time frame. And in this one, we also look at the 15-year period. The average annualized rate of return for this particular index strategy is 4.56%. And then coming on down, we'll see a 60% participation rate on the S&P 500 daily risk control 10%. And we'll see an average of 4.54% with a 10-year high of 4.86 and a lowest 10-year period of 4.54. And that's going to really round out. Now, they do offer the traditional S&P 500, so I do want to make sure we cover that one as well. And it will have various caps depending on when you decide to purchase this particular product. Those caps can fluctuate, but we're looking at a 6% cap at the time of this review on the 1 year S&P 500 point-to-point using a cap strategy. So during the last 10 years, if you were using this strategy, the average rate of return on an annualized basis over the last 10 years is 4.16%. And then the highest 10-year performance from December 30th of 2004 to December 30th of 2014, we would have experienced a 4.23% average annualized rate of return. And then the lowest 10-year period would have been from December 30th of 2001 to December 30th of 2011, showing us a 3.62% average annual rate of return. Over the last 15 years, the average rate of return using that particular strategy would have performed at 4.2%, and then the last 20 years at 3.89. So, one thing to look at is, these indexed annuities are not created to outperform the stock market, but they are designed to give a level of peace of mind, knowing that you can never lose any money that goes into this type of annuity due to market losses. And if you're looking at creating an optimal overall portfolio mix, instead of putting money in bonds, which is a pretty bad place to be in today's low interest rate environment, if you could go into an indexed annuity and get that guaranteed protection of principal protection from market downside, but have an annuity perform in the 4 to 6% range on average over a 10-year period, you're actually getting a better return than a bond would, especially today. And so, This is a strategy that we implement to our retirees and prospective clients looking to, de-risk a portion of your portfolio, but still give them an ample opportunity for a fair rate of return. And an indexed annuity positioned the right way is a very, very good alternative to do just that. Okay, so we've looked at the index strategies using our backtested performance exercise. The last thing that I'd like to do is take a moment to illustrate this particular product, just to give you an idea of what that would look like on a ledger, so you can really get an understanding of the way it looks on paper. So here we're going to take a look at the top strategy, which is the 1 year point-to-point using the S&P 500 average daily risk control. We're taking a look at a male age 60 in the state of Florida, and he's putting $100,000 into this particular annuity. Okay. Now, again, you do have the ability to diversify within the index strategies themselves. So if you had 100,000 in, you could put 25% or 25,000 in 4 different of the index strategies themselves. And, I think that would really, looks like I may have made, no, I didn't. Okay. Thought I made a typo, an error there. So, okay. So let's take a look and see how this thing looks. All right, if you haven't done so already, in the bottom right-hand portion of your viewing window, you can click that box icon, and that should enlarge your viewing angle. So hopefully that can improve my screen size here so that you can see everything that I'm seeing in a much more optimal manner. All right, so let's come down to the current rates that are offered. So we have a year one, $100,000 in investment premium going into the annuity. And you'll notice the green column here, the fourth from the left, is the account value. You'll see the fifth column from the left is the interest crediting rate. Now, this is using the last 10-year period, showing us how this product would have performed over the last 10 years and how this account value would grow over the next 10 years if the last 10 years had repeated themselves. So one thing to note, too, is at the far right-hand corner of this screen, you'll see the death benefit column. And as I said earlier on in this review, you'll see that the death benefit column always matches the account value column. Should you pass away during the time of your surrender period, in this case, it's 7 years, obviously that money, that death benefit proceeds would pass on to your designated beneficiaries in the contract and avoid probate. So there would be no surrender charges incurred if you were to pass away during the first 7 years of owning this product. So we'll see year two coming in is an interest credit of 4.25%, growing the annuity up to $104,251. You'll see the very next year, 14.24% was credited, giving the account value at the end of year three a total of $119,099. Now, you will notice in the fifth year, well, the first year there was a zero, and in the fifth year there was a zero. That indicates that in those times, or in those given years, there was a negative performance or a flat performance, and so an interest credit of 0 was given. So you'll notice that from years 4 to 5, the account value does not grow at all, and it also doesn't go down. It stays right where it is. So that proves to you that there's no fees. It also proves to you that there's no losses incurred due to market downturns. Year 6, you'll see a 3.55% interest credit come in, growing the end of year balance to $126,951. And then year 8, you'll also come in and see a 0 credit that's given during that time frame to indicate another flat year or down year for that index strategy. And you'll notice again that the contract value does not change. And then we'll see end of 10 years. So at the end of 10 years, the account balance grows from $100,000 to that end of that 10th year to $161,480. So you can experience, based on this illustration, how it potentially could perform if all things were created equal today, as in the offerings of the product today, and we backtest them over the last 10 years. This is the kind of growth that could have been experienced, all with a high level of peace of mind, knowing that even in bad years, the worst case scenario would have been a 0% credit for that given year. So if you're in the market, you're looking for a safe accumulation vehicle, you're not finding the common yields that we once had in bank certificates of deposit, money market accounts, or bonds, and you're looking for a guarantee of principal protection, an indexed annuity like this could be one that would be a suitable alternative for you. If you'd like to take some time and compare this particular product to another one that you already own or that you're thinking about purchasing, or maybe you're just trying to find the right annuity for your particular needs in retirement, if you'd like to work with me directly, I work with clients in all 50 states. We utilize Zoom over the internet to use a secure platform to chat face-to-face, just like you're watching this video. And if you'd like to do that, I'd be honored to have that opportunity. You can visit my website at annuityassociation.com. Right there on the main page, click the green button to request your free report. There you'll be taken to a opt-in form with a series of questions. And one of those questions being, would you like to be contacted by an advisor? Simply answer yes. Obviously leave your phone number and I'll reach out to you in a timely fashion to see how I can help point you in the right direction. So thanks so much for tuning in. Give us a thumbs up, share this video with friends and family if you've gotten some value out of this, and stay tuned for future reviews here in the near future. I'd like to sincerely thank you for the time you spent with me today, and very thankful for this opportunity and these platforms that we have to disseminate this important information to help you make educated decisions with retirement. So Jeremiah Conger signing off. Everybody have a great day. Take care of one another. Thanks so much.